Welcome to part 2 in my 2-part BDC or Business Development Company Investing series. If you've not watched part 1, please make sure you watch that first because this video builds upon it. In my first video, I began my analysis of 3 BDCs I currently have in my portfolio. Those BDCs are Main Street Capital Corporation, ticker MAIN, Gladstone Investment Corporation, ticker GAIN, and Ares Capital Corporation, ticker ARCC. 2 of these, MAIN and GAIN, pay a monthly dividend and have also paid special dividends. In part 1, I explain what a business development company or a BDC is, a summary of how to analyze one, and a comparison of MAIN, GAIN, and Ares looking at dividends and price performance as well as NAV, NII, the non-accrual ratio, and weighted average portfolio yield. If you have no idea what one or more of those things are, then please go back and watch part 1. In today's video, I go further into each of these 3 companies, their specific portfolios, their diversification, their historical returns, their valuation, and which I plan to sell and which I plan to buy. I'll also discuss the pros and cons for this sector right now and what I'll be watching in terms of the economy as I move forward with my investments in BDCs. Make sure you subscribe so you never miss a future video and hit the like button because these videos take me an enormous amount of time to create. Now let's get started. As you will recall from part 1, BDCs like Gladstone or GAIN have their own portfolios of companies that they have invested in and loaned money to. It is important that we review the portfolios of BDCs to better understand what they are focused on. Looking at GAIN's portfolio, we can see their portfolio can be broken down into 3 categories: manufacturing, business services and distribution, and consumer products. If you're familiar with any of these companies and have wanted to invest, GAIN may be a great way to do so. The companies in GAIN's portfolio are geographically diverse, as you can see on this map, and they span the United States. Ares is a much larger BDC and therefore has a far larger portfolio. As you may recall from my first video, Ares is the largest BDC by net assets and by market cap. If you look here, you can see the breakdown by industry composition. None of the industries in their portfolio make up 20% or more of the total portfolio value. They have the largest amount in healthcare services, software and services, and commercial and professional services, which I see as safer areas to invest. Areas which I see as a bit riskier with the economy, like energy, is only at 2.6%, and materials is only at 1.7%. Geographically, they are well diversified with 25.3% as the largest geographic area in their portfolio. Their portfolio is also well positioned and diverse in terms of asset class and issuer. The largest investment in their entire portfolio only makes up 3% of their portfolio, and the average position size is only 0.3% of their portfolio. That means that for them to take a big hit, many companies in their portfolio will need to default. Here we are again seeing the Ares portfolio breakdown by industry, which looks quite well diversified. As I mentioned before, I don't like to see too much in risky areas like oil and gas. Here you can see that for the areas most hit by the recent crisis, Ares is well positioned. In hotel and gaming, the high yield and leveraged loan industries have about 7 and 8% exposure respectively. Ares has less than 1%. For oil and gas, Ares only has about 3% compared to the much higher 13% for the high yield industry. Only 2% in retail and distribution and only 1% in media and entertainment also looks favorable. Last, we look at MAIN's portfolio. Like Ares, MAIN has a beautiful diversified portfolio across a wide range of industries. In other words, both have diversification well beyond that of GAIN, which is not surprising given that they are both much larger. The highest percentage is in machinery at only 8%. MAIN is also well distributed geographically across the country with their biggest percentage for only one region at 26%. Well, let's take a quick look at fast graphs to see how Ares, GAIN, and MAIN stack up. We are first looking at Ares. Before we look at the graph, please note that the blended PE is only 8.26. That is amazingly low, particularly given the 17-year normal PE ratio of 10.55. Earnings growth has been slow for Ares, which is not surprising for a BDC, and it comes in at 2% annually. The market cap is almost $5.6 billion. Remember that number as the comparison for how small GAIN is relatively speaking. Ares has an S&P credit rating of BBB-, which is encouraging given many BDCs don't have a credit rating at all. The dividend yield is currently a massive 11.68%. Now look at the graph. The dark green is earnings, the orange is the fair value line, and the blue is the normal PE ratio line. In other words, the blue line shows us where Ares usually trades given its normal PE it typically trades at. The black line is the price. Because the black line is well below the blue and orange lines, we know that the price is well below fair value and the normal PE, other than in the 2008 financial crisis where the share price took a massive beating. The share price has done a good job of following earnings. You can see that as the dark green raised or lowered, the black line has done so as well. More recently, the dark green earnings has again dropped because of this new crisis. However, the black line for price dropped far faster. This is where I see an amazing opportunity to invest, particularly given that you can see that analysts are expecting earnings to slowly recover in the next 2 years. I think that the share price overreacted. Let me show you why that is so exciting. I have plotted here what would happen if you had invested back in 2006 when the share price was at fair value. If you had held until today, including dividends, you would have only returned 4.7% annually. That's not particularly great. However, if you had bought at the bottom when the stock was at an amazing valuation with a ridiculous PE of 2.57, you would have returned over 20% annually for 12 years. Now you might be thinking that this would only happen if you perfectly timed the bottom, which is unreasonable to expect anyone to do, and that's a good point. But if you had missed it by half a year and caught it well on the way up after it had already recovered 112%, you still would have gotten nearly 13% annual returns, which I would be very happy with, especially if reinvesting those dividends, which would have further increased those gains. I believe that we are in another situation not so different from 2008 and 2009. Buying now will give us far better gains than if we bought a year ago or if we buy in another 2 years. Looking at their historical performance, if we had reinvested dividends for the past 17 years, Ares outperformed the S&P 500 with a 9.8% annual return compared to the S&P 500 8.8%. Yield on cost for the dividend would be a massive 42%. Now let me point out that although I focus primarily on dividend growth stocks, Ares is not a dividend growth stock. In the past 17 years, they've had 4 dividend cuts, although all were fairly small. They also have had 3 years of 0% growth. Their compound annual growth rate for the dividend is only 1.6%. Ares is not about capital gains. Ares is not about dividend growth. Ares is about a massive dividend yield, and they deliver. If Ares returns to its normal PE by the end of 2022, according to the FastGraphs forecasting calculator, we would see nearly 19% annual returns until that time with a dividend included. How about for MAIN? MAIN's share price has tracked earnings quite well. In this case, the normal PE has almost perfectly matched the fair value price. Currently, it's trading just below its normal PE and fair value. It has much better earnings growth than Ares with almost 8% annual growth for the past 13 years. The blended PE is currently 14 compared to the normal PE of 15.16. The market cap is almost $2 billion compared to Ares' $5.8 billion, and it also has a BBB- rating by S&P. Like Ares, buying when the price drops can give superior total returns. If we bought right at fair value in 2008, we would have seen returns of 11.7% annually. Not bad, but if we had waited just a few more months when it dipped, we would have gotten nearly 16% annual returns instead. Like Ares, buying when below normal and fair value leads to outperformance. Since 2008 at IPO, MAIN has blown away the S&P 500 when we are reinvesting dividends with 14.5% compared to 8.6%. $10,000 invested in 2008 in MAIN would now be worth approximately double what it would have been if invested in the S&P 500. Similar to Ares, their yield on cost would now be a massive 42.2%. MAIN has a very impressive compound annual growth rate of 18.1%, although this is primarily because of an initial massive raise of 331.8% in 2008. Typically, their raises are around 5 to 6% annually. Although FastGraph shows a small dividend cut in 2017, I was unable to find that on Fidelity or in MAIN's own data. I do not believe that they have ever cut their dividend. In fact, MAIN shows in their own data that their recurring monthly dividend has never been decreased and has grown by 86% since IPO. If MAIN returns to its normal PE by the end of 2021, including the dividend, we should expect to see around 14.5% annual returns, which I would be very happy with. As a final point on MAIN's historical performance, their portfolio investments have grown by 2,189% or 212% on a per share basis, and DNII per share has grown by 222%, which is amazing. Also note that, although unsurprisingly 2020 is expected to be below 2019 and 2018, it is not as bad as some have feared, and it actually is still better than for 2017. MAIN shows that since IPO, it has outperformed, achieving 517.73% total returns compared to its peer group, which returned 298.5%, the S&P 500, which only returned 163.4%, the Russell 2000, which returned 108%, and the KBW Regional Bank Index, which actually lost 21.88%. Last gain has generally followed earnings, but at a lower valuation until 2017 when the price considerably increased. I'm only showing the last 14 years because FastGraph shows an extremely high price at the 15-year view, which obscures the rest of the data. In the past 14 years, their earnings growth is actually negative. Their market cap is only $300 million. Compared to the $5.8 billion for Ares, Ares is more than 19 times the size. Like many smaller BDCs, GAIN does not have a credit rating. GAIN is shown to have had 3 dividend cuts, but the last 2 are also errors based on Gladstone's own data, which I reviewed on their website. The errors may have been due to the special dividends that they pay out, which have made their dividend history seem less smooth, as some quarters have additional payments, which are of varying sizes. The 50% dividend cut, however, is real. There are a number of years in which GAIN has not raised their dividend, and the raises have often been small. GAIN, even with dividends reinvested, has slightly underperformed the S&P 500. Based on FastGraph's forecasting calculator, if the share price returns to the normal PE by the end of 2022, given expected reductions in earnings, we would only see a 1.2% annual return, and that is with dividends, given capital depreciation of 12% is expected. Briefly, what do analysts say about our 3 BDCs? Morningstar sees fair value at $43.56 for MAIN, placing the current $29.93 share price well below. MAIN is estimated to be undervalued by a 31% discount, and it has a narrow economic moat. GAIN, by comparison, has a Morningstar fair value of $11.65 compared to its current $9.07, making it 22% undervalued, and it is rated as having no moat at all. Ares is at $13.70 but has a Morningstar fair value of $18.87, making it 27% undervalued. It is a narrow moat like MAIN. Morningstar tracks MAIN's share price relative to its fair value. You can see that since 2012, the fair value has tracked the share price quite well up until very recently when we see a huge disparity. This is again where and why I see opportunity. Looking at GAIN, we see something very similar. Adding in Ares, we again see the same as the markets have reacted very negatively to financial sector stocks, especially those in lending during the crisis. I told you I would be discussing what I am buying and selling. I have been looking to reduce the total number of positions in my dividend growth portfolio to focus more on quality and to make space for some potential new stocks when a good opportunity arises. I would ideally like to have not much more than 25 positions. Given I own all 3 of these BDCs, I think this is too many, and eliminating one is a good way to better focus my portfolio. Of the 3, I believe GAIN is the weakest, and that's not to say that GAIN isn't a good investment and that you shouldn't invest. I've been an investor in GAIN for many years myself, and there's nothing wrong with anybody else investing in GAIN. My choice to sell it, however, is because of credit rating, market cap, assets, diversification, its lack of internal management, its NII growth relative to MAIN, its non-accrual rate, its dividend growth history, its price performance, its future earnings potential, and its current valuation. As a result, I plan to sell it. I intend to invest the money I receive from the sale into Ares and MAIN. Now for things to consider for the industry. The huge threat and major news story for BDCs is the current health and economic crisis. This has and will create a credit shock, and that's already occurring. As you saw in part 1 of my series, default rates for all BDC portfolios is on the rise. Given BDCs cannot hoard cash for such situations as they must pay out 90% in dividends, they can be particularly vulnerable to those defaults. Some BDCs are heavily invested in gas and oil, although Ares and MAIN are not heavily focused there. I believe the current crisis makes BDC investing even more risky, but that doesn't mean I won't invest in BDCs. It is only a reminder to focus on the highest quality BDCs. Another note is that expenses have risen for many BDCs for the past several years, particularly as some like MAIN and ARCC have rapidly expanded. Countering some of the current economic issues, however, are what I see long term. Economists see this market as having huge future growth prospects. There is growing demand for customized financing, which, when combined with the current near-zero interest rates, will continue to boost demand for our BDC services. I believe MAIN and Ares have sufficient liquidity and credit facilities to cover debt as it stands until the time that we see future recovery. For example, although Ares is quite leveraged, it does not have any debt maturities due before 2022. Take a look at this chart on Ares. On the top is earnings per share and the bottom is sales or revenue. 2020 sales is actually estimated to still beat 2018 and 2021 will almost be back to where 2019 was at an all-time high. Looking at earnings per share for 2020 and 2021, it is still expected to do as well or better than it did back in 2017, 2016, or 2015. The share price during those years was typically between $15 and $17, even though it is now only $13.70. In fact, Refinitiv analysts, based on the earnings per share data you see at the bottom half here, are expecting a big improvement in share price within the next 12 months. Assuming it reaches a 12-month price target of $15.90, we would see a 19.8% increase. When we add in the dividend, which is over 11% currently, we would have more than 30% annual returns. The low target is $14 and the high is $17, which is not unreasonable as you can see here because it was trading at $19 before the crash. Now what do you think? Are you investing in BDCs? Which of these 3 is the best? Which would you rank as the worst? Leave your thoughts in the comments below. I look forward to hearing from you. Don't forget to hit the like button, and as always, good luck with your investing.